We're going to start this presentation by looking at a specific bull put credit spread that is in trouble. This comes from one of our YouTube members, Zayn. I'm sorry if I'm mispronouncing that, but Zayn has an issue that we need to address, we need to discuss. Well, Zayn has a losing trade. At some point recently, he opened a bull put credit spread on SHOP Shopify. He sold the 25 June expiration, 1265 put, and, well, I assumed that he bought the 25 June 1260 put as well. He didn't. We'll get into that a little bit later. But now the stock is trading at around 1205. So it's below both strike prices and we're near the maximum loss in the position. We're also going to assume that the position was entered around May 28th to June 1st based on where the stock was trading at that time, where the 1265 would have been at or slightly out of the money and the 1260 would have been further out of the money. Zayn asked for help on a YouTube video, commented on our early assignment on a credit spread because he feared he's in the situation where he may be assigned early on the 1265 put and have to put up $130,000 to cover the obligation of the short put strike price. Zayn's initial comment: I'm a beginner, and that's perfectly fine, Zayn. We've all been there before, and we've all opened new strategies and new positions at one point in our career as well. But he's in shop, bull put credit spread, the strike price 1265, expiration of June 25th. With the stock trading at around 1205, right now we're deep in the money, and he can't get out of the position due to the low volume and the open interest. Zayn needed to know, what would you suggest me to do now? As if I get assigned on the short put strike price at 1265, I won't have the funds in my account that I need to buy the stock. Essentially $130,000 for one contract. And I think he actually has more contracts than that. We don't have the $130,000 to buy the shares. Please help. Let's take a look at what we can do for Zayn. So in Zayn's position, he sold a 1265 put on Shop and bought a 1260 or somewhere along those lines, and the stock is now down to 1205. He can be assigned any time on the short put. Just being in a spread doesn't cancel the obligation. If the stock was between the strike prices, you can still be assigned at any time on a bull put spread and be forced to buy shares of stock. Naturally, you could just sell them out. If it's below both strike prices, in this case, your broker is likely going to exercise the long put to deliver the short. They will essentially buy shares of stock at 1265 and immediately sell them at 1260. We wouldn't have to put up the $130,000 for one contract or close to it. We are going to get the full loss in the trade, but the initial credit would offset our loss. If you're going into spread trades, anyone, if you're going into spread trades, check with your broker to make sure this is how they handle early assignment. We're going to talk about this a little bit differently with Alice's question in just a moment. You would have to put up the margin requirement to cover the strike prices, of course, at your broker. So that capital is there to fulfill the loss. But if it's below both strike prices, your broker should exercise the long to deliver the short. Now, with Zayn only telling me that he sold a 1265 put and a bull put spread for the June 25th expiration, how did I analyze this position for my 8-point reply that you can see on YouTube? Well, the first thing is we looked at the stock chart for SHOP. And I assumed that Zayn would have entered this bull put spread at some point when the stock was above 1265. It was there on April 28th. The closing price was 1288. May 20th and May 24th, it was around 1261. And then that end time there, around May 28th to June 1st, it was right around 1255, 1256, I think a high of 1271. What I'm showing you in this position, why I'm showing you this, is to show you how I go through and analyze any question that comes into me for those positions. Jeff made a quick comment here. He says, you shouldn't get into spreads that you can't afford to get out of. Don't trade expensive stocks until you get more experience under your belt. And that's fair, and I agree. And thankfully, Zayn is not in that bad of a situation as we look at it now, Jeff. But absolutely, I agree with you. We've all been there, right? We've all made our first trade for the very first time at some point or another. But in this case, if you've got a 5-point spread or 2.5-point spread, you'd have to have the margin requirement to cover it. But I agree with you. Some of these spreads can get very risky. I saw the 3 dates when it was potentially analyzing Zayn's question, where he potentially could have gotten in so I could get a rough gauge of the prices. Then I went into PowerOptions and took a look at the stock research tool because I wanted to check to see if there were earnings coming up. If he gets assigned early on that short put, broker is going to exercise the long to deliver the short, so he'd have the full loss on the trade, but he's not on the hook for $130,000, thankfully. But he is trying to actively exit the position. He's just not getting filled at the right prices he wanted. We'll see that in a moment. There were no earnings coming up between now and expiration. That's not a factor. Why would it be? If I'm in any type of spread, or perhaps even a long call option, or a long put that's going against me, and our expiration is, say, the 25th of June, if we had earnings coming up on the 10th of July, the 10th of June, the 18th of June, if I'm already near a 90 or 100% loss on that position, I might as well just leave it open through earnings. If I get a big surprise and it comes back and I can get out of my position for less of a loss, maybe only a 50% loss, maybe a 20% loss, or in an extreme case, maybe it comes from a loss to a gain. Well, if I'm already at 90, 95% loss, I have nothing to lose by leaving it open. But in this case, that was not going to happen. So I wasn't even going to address that with Zayn. Next, from the option chain, we went into the put research. And I was looking at that 1265 put. And I went to the research tool. And on the research tool in PowerOptions, you can see the price history since that option was released on the market. And that's what we're looking at here. The default graph is comparing the option bid for that particular option you're researching versus the implied volatility. You know, also look at other factors such as stock price, delta, percent out of the money, I believe, probability versus implied volatility or versus the option bid price as well. So this gives me a target range more along the lines of when he entered the position. This 1265 put was first released on the market on May 27th. So I know that that April date where we saw the position is out. The May 20th date that was a possibility was out. He didn't enter it then. It would have to have been after May 27th when this option was first released. So it could have been the 28th. The 7-week series, did come out on May 14th. But again, that 1265 didn't come out to May 27th. So the position was likely entered May 20th to June 1st. Even though the other options were out for May 14th, there were only the 10-point spreads at that time. The additional 5-point spread, the 1265, the 1275, didn't come out until the 27th. And the 2.5-point spreads, the 1262.5, the 1252.5, they came out about the same day. So it was a slow release for the 7-week out series for this. So now we knew he would have entered it around May 28th when the stock closed at 1242.87, but it hit a high of 1271. On June 1st, shop closed at 1251, but we had a high of 1278.93. Right? So he might have entered it somewhere in that time frame. And this is not how we personally structure our bull put credit spreads. Pierre asked a question about that. We have 2 slides at the end of this presentation where we show what we would look for on the stock and what we look for on our default search screens. But on June 1, at the closing prices, we could have sold to open the 25th June 1265 put for 58.25 at midpoint. Bought to open the 1260 put for 55.80. This would have been a net credit of 245 on my assumed structure, the 5-point spread, which is about a 95% return. Because the true risk on the position is the difference in strike price 5 points minus the net credit, or only 255. So the profit and loss from the assumed spread, we would have taken in 245 net credit, risking only 255. It's close to a 1-to-1 risk-reward ratio. But the stock is well below both strike prices, closing today at around 1205. This was from yesterday at 1199. Now, if we hold it to the 25th of June, Zayn did check with his broker, and he was assured that they naturally would exercise that long to deliver the short. In this case, he'd be out the 5 points, the difference in the strike prices, we keep the 245 net credit, so he'd be down 255. His prices were slightly different, and he did use a different structure. But in any case, he could liquidate right now for a lower loss. Because there's still 4 weeks to go, 24 days, 23 days left to expiration, I believe, there's still time value left on both options. At midpoint yesterday, he could have liquidated a position for just a cost of 360, not the full 5-point loss in the spread, even though it's deep in the money. We keep the 245 net credit, so the loss would have only been around 115 on this position, of course, times the number of contracts. Now, there was a low volume and low open interest, 7 open interest and some low volume, and the market price at liquidation. We're using the midpoints, and that's what I would target to open any spread or close any spread of this case. But the natural bid to sell to close that 1260 put, the natural ask to buy the 1265 was a debit of 710. $2.10 higher than the difference in strike prices. And this is why you don't ever go into a market order trying to liquidate a spread position or trying to enter a spread position, because you can technically hurt yourself in that case. Zayn posed us with a problem on his specific position. We went backwards. I showed just briefly how we'd use some of the tools to research your questions as you send them in. And then, of course, that 8-point response I gave to him was June 25 series was not released to May 27th. So you didn't give me enough information, Zayn, but later you did. But that meant we likely entered it around June 1st or May 24th when shop was bouncing on those prices. At midpoint, still had a good net credit. Actually, the close on the day before, the 28th of May, was 285. I'm sorry, that was on May 20th, 225 on May 24th. And it was about, instead of 245, I think it was 260 at midpoint using May 28th instead of June 1st. But because of the stock that went down, the prices of the 5-point spread on when I talked to him, that was on June 3rd, was that the buyback cost midpoint for the 1265 put was at 82.50, and then the June could be sold for 79.20. Debit to close would be 330. So this was still representing a small loss of around $1.05, or depending on what credit he got in that case. And then, of course, at natural prices, the debit was much worse. That's why we don't ever suggest liquidating or even opening a spread at those prices. Now, I did see that although we mentioned low volume and open interest, the 1265 had 7 contracts traded yesterday. That would be June 2nd in this case, and 1 contract traded on June 3rd. And it was a good price of $83. That's a little higher than the midpoint. We'd hope to buy to close it at $82.50 when we looked at the midpoint price, but the ask price was $84.30. So it's still a good fill price that got into that near midpoint range. Instead of paying the extra $1, would be getting closer to the market order price of that position, which was way off and, of course, larger. So those were the first 6. The other 2, of course, we already talked about number 7. Know that you can be assigned any time on these spreads. Just entering a spread does not cancel the regular obligation of just selling a naked put, selling a naked call. You still may end up having to deliver shares of stock at a strike price or buying shares of stock at that strike price. We cap the bottom side with the extra put and the bull put credit spread, so we can't lose more than 250, 5 points minus the net credit, or maybe 10 points minus the net credit in that case. But we could still suffer 100% loss on the position in situations of this nature. That's why proper position sizing is also key. If you're going and you're starting to get into credit spreads right now, you're starting to get into debit spreads, and you're starting to get into diagonal spreads, we'll talk about briefly in a few moments, check with your broker to make sure how they handle the situation. Most of them are going to do it in the case that Zayn is going to see it. They're going to exercise his long put. His is actually the 120. I'm sorry, it's the he did the 1265 and the 126250. Okay, so he's a 2.5 point spread instead of the 5 point spread that I assumed. But they are going to exercise long to deliver the short. That would give him the full loss. He could likely liquidate now. Put it at midpoint. If the order doesn't get filled, in that case, maybe then adjust it slightly. Don't pay the market, but try to get better, definitely, than the 5-point difference in the strike prices right now, and try to get close to that midpoint. Since the position is near full loss, none of the really 8 ways to manage a bull put spread that we teach would really work. You can't do a pendulum in this case. You could close it and take the loss and then roll down to another expiration further out in time at lower strike prices. But again, what did we not want to do? We didn't want to sell an at-the-money bull put spread. We want the proper structure. But now, in this situation, it's best for him to liquidate the position, get close to midpoint, not filled right away, move the limit order to try to get filled. Just don't go too close to the spread at market, and don't go beyond the difference in the strike prices as we saw that market price was. And of course, earlier, where were we now? Well, we got, in my example, the 5-point spread. We got the 245 initial net credit on the position, and that's shown right over here. So we got the 245 initial net credit on the position. Buyback cost was at 360 earlier, so the loss is only 115 if you get filled at the midpoint prices in that case. And so it's still not as bad as that, and the stock moved up yesterday as well. I'm sorry, moved up yesterday, moved up a little bit more today as well in that case. So the buyback cost was actually a little bit, the loss was actually a little bit less. Okay, so we saw the structure. We saw in the stock price, when maybe even if Shopify had hit that high at 1278 and Zayn had entered it right at that point, selling at 1265, 1260, that's not really the proper structure we would prefer to use. And Pierre's question via email was, last week you told me on your webinar that one of your best income methods was the OTM bull put credit spread. Can you show us an example of how you would set up that trade with the strike price? Well, I usually use the PowerOptions search tools. Our default weekly bull put is specifically what we would look for to enter into a bull put credit spread. It's looking for an 85% probability above, which usually translates to a delta of around 0.15, at least less than 0.2 for the sold option delta. This would put us pretty much far range out of the money. It's going to be different for each stock, how far out of the money it actually is. So I'm sorry it got cut off here at the edge. I was trying to put this together as quickly as possible before today's presentation. On June 1st, at the close, and it closed at 1251, we knew it hit a high of 1278 on June 1st. Zayn had entered the 1265, 1262 and a half spread. It had about a 54% probability of expiring worthless on June 25th. If I open the chain Pierre on that same day, or so I have to look at the closing prices, I would have gone down and my eyes would have gravitated to that probability above column, as we're seeing here. And I would just look for the ones first that have the 85% probability or higher. That's my starting point. That's the structure I would use if I was building it on a stock. Again, I use the search tool to find the positions that match my criteria specifically. But in this case, same day of what we just reviewed, Pierre, I would look for that structure. I would look for that first one there with the 85% probability or higher. And how would I structure it from there? Well, I look for that 85% or higher. It was the 1122.50 put. And then I'd look at the evaluation of doing a 2.5-point spread or the 5-point spread. I typically like to leave a strike between my positions if possible. Sometimes I don't. But the reason I like to leave it there is one of our 8 ways to manage a bull put credit spread. If the stock started to move against me and fell within my 1% rule of the short put, one opportunity you may have is to just buy to close your existing short and sell to open the one between. So in this case, the 1120 put is between our 2 strikes. We'd be selling the 1122.50 for 10.95, and we could buy the 1117.50 for 10.25. That would have given us a 70-cent net credit or a 16.3% return on the 5-point spread. Leaving the strike between is so that if the stock falls here, and I have different management techniques I could use, or I could just exit the position entirely. But one of those is you can consider buying to close the short, rolling it down 1 to that next strike, the 1120 strike. It's right about here, I know. And you still maybe have a small profit. Might not be the highest profit in this case. It might be half or a little bit less of what you originally expected. But you're converting a losing trade right now, if liquidated, into a potential winner if the stock stabilizes and then moves back up in price. And as you can see, even though Zayn's position got threatened immediately and he's near the full loss because he was up at the 1265 strike here and the 1260. Okay, well, it's much higher. It'd be up here. Sorry, folks. That 1260 position here, he's at the full loss in the trade. He took in a lot more net credit. He was looking at almost a 95% return on the position, but only had a 54% probability. This position, with a 16.3% return on investment, was never threatened even when the stock was down to $11.99. You're still deep out of the money in this case, starting with that 85 probability. You can still get a good net credit and still get a reasonable return in that position. And of course, though, it would have also had to match the stock criteria that we look for in that bull put credit spread default screen. And at the same time, I likely wouldn't have gone out 30 days. My preferred time frame, our preferred time frame, is going 11 to 14 days out in time. The 2-week series, usually opening positions on Monday and then selling them for 2 weeks out. All right, so to review, remember, anytime you do any spread position, early assignment can happen. If this was between the strike prices at one point, we could have been assigned on the short put early, and we couldn't have used the long to cover the obligation. We would have had to buy shares of stock at the full price. As Jeff mentioned, might not be a great idea when you're first getting started in these spreads to start off with those higher strike prices, because if the stock falls between them, that long put is still useless, and the short put could be assigned at any time if it's between those strikes. And we're talking about a lot of money there, as Jeff mentioned in that case. But if it's below both strikes, the long should be exercised to deliver the short. Always check with your broker. Best not to trade credit spreads right at the money, regardless of your expectations. You want to go further out of the money. We prefer to look for an 85% probability, delta of usually 0.15, maybe 0.2 or less on the short option. Go out of the money and look for that delta. Use stock criteria that you would for any bullish strategy. What do I mean by that? I'm not going to say that Zayn did this. I don't know. Okay. Shopify wasn't necessarily one of these meme stocks, the Reddit stocks that's been talked about recently. But we did look at the stock chart briefly. We saw some large gaps in Shopify followed by some quick retracements. Those news stocks, stocks in the news, volatile stocks might not be the best for these types of strategies. For a bull put credit spread, I want something that's showing a consistent trend in strength. And again, I'm still setting myself up to go deeper out of the money to have that higher probability of the trade working in my favor. And of course, once the stock starts to reach, and I don't think Zayn had that chance, because even if he entered it when it was at 1278 on June 1st at the high, by the time it closed, it was at 1251. He was already below both strike prices. It could have been closed or managed the next day, possibly. But as the stock starts moving to the short put strike price, our one suggestion is to use that 1% stop rule, adjusting it if the stock hits 1% of the short put strike price. Now, before we get to Alice's question, I had a last minute question come in via email from our good friend Chuck. And we're going to take Chuck's question because it's related to this concept that Pierre asked about and that we're helping out with Zayn as well. And we're talking about the structure of a credit spread or a debit spread. And I didn't have time to put it into the slides. Printed it out here, and I'm going to read Chuck's email. I'm going to cut out the first part, Chuck. Thank you for saying that. I'm glad you're getting a lot of use out of the webinars and the discussions that we've had via coaching sessions and email as well. So Chuck says, I work closely with Jim Allen, a good friend of mine from Alabama. He convinced me to switch from using the percent in the money or percent out of the money fields to using delta for my spread scans. While the percentages worked reasonably well, the deltas take IV into consideration. I just had my best week ever using all 4 of the vertical spread types. 82 trades, all profitable, most of the credit spreads expiring worthless today. The debit spreads are all in profit, and the remaining credit spreads expire next week. If you can spare 6.3 minutes, sorry, if you could spare 6.3 minutes, I would appreciate your comments on my bull put credit spread. I'm happy for you to share anything you see there with your other users. And then, of course, to refresh your memory, I create long and short lists using Vantage Point software. Enter the orders before I go to bed. He's out in New Zealand there. Chuck's out in New Zealand there, so he's not doing a trading day. So he runs scans, and then he puts the positions in to get there. It includes with one very happy customer. All right, so now that we're talking about the structure of bull put credit spreads, what I wanted to do here is I'm not going to show the name, so I'm sorry, I'm setting this up specifically. Here we go. This is Chuck's screen for his bull put credit spreads. Chuck is using a time frame of all expirations 3 to 23. 3 days out of times 23. So you can see a 1 week out series, 2 week out series, 3 week out series. That's perfectly fine. In my testing, we found that the 2 week out, that 11 to 14 days out we mentioned, seemed to give the highest return over different years of testing and trading. The 21 day out ones weren't bad. It's just the 14 days seemed to be higher return overall. Looking for a minimum net credit of 9 cents and a return minimum of 6%. We're at 9% for the minimum return on our bull put weekly screen and a slightly higher net credit. Now, on this one, Chuck, you still do have the range out of the money of 8% or more, but you started using a delta of, I'm sorry, the short option delta, you should just say greater than 0.09. If the short option delta is greater than 0.09, negative 0.09, puts have the negative delta, so a value of negative 0.08 is technically greater than negative 0.09. You're less negative in that case. But for the bull put credit spread, the strike price lower, Chuck is always going to be a lower option delta than the short. So you can just use the short option delta. You don't necessarily have to use the long, especially if it's the same value. But you can choose to do that. Also, if you're using the delta of minus 0.9 as your filter, you probably don't need the probability. And why do I say that? You had mentioned that you decided to use the delta because of what we talked about in the webinar, that our equation takes into account the implied volatility. So does the probability equation. And though you only had 2 searches that met your criteria, one seems like a slight outlier here because of the higher net credit in this case. Let me see if there we go. You can see here that your probability above is around the 91.4, 91.3% range, with a short option delta minus 0.8 and minus 0.7. These are fairly closely related because on PowerOptions, we use the implied volatility for the calculations to determine those equations, the delta and the probability. So what I mean by that is if you're looking for a delta of greater than negative 0.09, your probability is already going to be at 90% or higher. You don't need to put 80%. Anything that has that delta, they sort of work hand in hand. So they're already there. I'm not saying you're over-filtering by any stretch of the imagination. I'm just saying those 2 criteria sort of go hand in hand. And of course, you put in an 8% out of the money, which is perfectly fine. That's probably better for looking out for the 1 week series, because some of these deltas that you have of negative 0.07 on 4 days to go to expiration or 7 days to go to expiration, they might actually only be 5 or 6% out of the money on a lower volatile stock. So I think that's fair to keep in, because you don't necessarily need to use both delta and probability. And as I mentioned, the short option delta is your focus. If the short option delta is in that negative 0.09 range or below, your long option delta will automatically be below that. You don't need to filter by both. Okay, so why am I showing this? Well, this is just to help Pierre. I have my way of doing it, and I have tested extensively my way of doing it. Here's another way of doing it. Look at the return. Now, this is why I said the outlier. I think there's a bid-ask spread outlier on this particular bull put spread that you're looking at, Chuck. I don't know if we could get the $1.70. This is a bit wide. This isn't that wide, really. I mean, getting 8.10, 8.15 might be plausible, but this seems pretty wide. The second one seems more realistic, and this is what we'd expect. You've heard me talk about the bull put credit spread criteria that we use. I'm not going to pull it up right now because it'll show Chuck's name and everything, and I don't want to do that on his search results. I'm on his search result right now on Google Chrome. It's just another way to skin a cat, in this case, Pierre. My target return, and what you saw when I showed what I would use for the Shopify position, even though that was 24 days out in time, as opposed to the 14 days here. but it was a 16.3% return. The target I look for with the 85% probability or higher is around a 15% return. This is what I'd expect to see and what I saw in my testing when I increased the probability to say, okay, if I want greater than 85% probability over this time frame, what returns would I have seen and success rate? I go to 90% probability or 95% probability or higher on the same stock criteria. What do I expect over time? That's how sort of the testing worked. And this is what you expect. Close to half the expected return in most cases, only 8.7% for this URI position, with a 90, 92, 93% probability. Going to a 95% probability, you might only be expecting a 4 or 5% return on investment for 14 days out of time. Whereas I'm looking at an 85% probability targeting 15%, and we've been able to average that over time. It's just a different approach to doing it. Both Chuck and I are using similar things here for the strike difference. I'm just using anything greater than 2, because the 1-point spreads I found oddly, but they didn't seem to work well over time. You're getting too little net credit. When you suffer a loss, it's taking out more of the winners. But getting 30 cents or 40 cents on a 2.5 or a 5-point spread, you take half of that loss, you've only wiped out 4 or 5 previous trades. The other thing with the 1-point spread is once it touches your short put strike price, the next day it can go suddenly below both to where you're beyond that 50% close price that we look for as a target. And he's not using any technicals or fundamentals other than the obvious. Always avoid earnings between now and expiration when doing any type of credit spread or debit spread. And he's also avoiding the ex-dividend date. That's perfectly fine. And as I mentioned, he creates his own bullish list to screen against. So he doesn't need to use a lot of stock fundamentals or technicals because he's creating stock lists based on those. And Chuck, you said that you got $1.50. Wow. Says you got $1.50 net credit on BIB spread right at the close date. And that's for next week's expiration. So $1.50 on your, is that a 5? Yeah, $1.50 on a 5-point spread. So you're at about a 3-to-1 risk reward ratio, right? You're risking you're risking $3.50 to make $1.50. So it's actually much better than that. Fantastic. It's a great fill price. This is not a recommendation or suggestion to open this trade on Monday. Open either of these trades just for Pierre. We're showing that there's different ways to do it. I have a way that works well that has met my target goals for this strategy, and that's what I share with you. I know there are investors that do better than I do, either success rate or return rate. And in this case, Chuck's probably going to have on a 7-day trade a potentially much higher percent return than I've probably had in months, more than months, using my approach for the bull put credit spreads. I'm averaging around this 15% returns, somewhere 21% returns. I think that's the highest I've gotten on a bull put credit. No, it was 26%. And that was in April when the volatility was still high, but the stocks had all started to come up above their 20-day moving average, and the MACD crossovers were all positive again. That's when I started reopening, was the end of April, and I had one that was a 26, 27% return somewhere in that phase. This one's going to be much higher. And Chuck adds, for me, PO has been great at finding the pricing errors with the proper structure. But thank you, Chuck, for sharing that with us. I'm not going to go through all 4 vertical spreads. I will look at that later and send you an email, of course, next week or over the weekend in relation to anything I might see in the debit spreads. I think this is really well structured. Just you don't need necessarily delta and probability. No harm in doing it. But again, all of your probabilities with this delta are going to be 90 or above in this case. And you don't need to use the long option delta. If you're already using the short option delta, the long option delta will already be much lower in that case. I like what you're doing here with the bid-ask spread. Limitations, the same thing I use as well. You are looking for a minimum 6% return. That's great. But again, that's what you'd expect when you move up a probability range, the 90, 95% probability. You're probably seeing credit spreads that are less of a 12, 14, 15, 18% return and more of a 7, 8, 9% return. And that's just the way the pricing works. Lower delta, further out of the money, lower premium, still high success rate. Pierre, I hope you found that kind of useful with some discussion on the structure, and I hope Zayn found that useful as well.